Welcome to Private Capital Call, the only podcast for institutional investors and asset managers of private capital around the world. Our conversations with industry thought leaders covers the economy, capital markets, as well as private equity and private credit. I'm your host, Randy Schwimmer. Joining us today as our first guest is Steve Segal. Steve, for a decade and a half, was executive in residence and lecturer at Boston University's Questrom School of Business. He developed and taught a graduate-level course in private equity and leveraged buyouts. Steve was also a co-founding partner of J.W. Childs, investing in middle-market growth companies, primarily in the consumer products, healthcare services, and specialty retail sectors. During his tenure, the firm completed more than 40 transactions with a total transaction value in excess of $11 billion. Today, Steve is primarily a private investor, frequently collaborating with others on early-stage ventures. Steve, thank you very much for joining us on Private Capital Call.
Well, it's great to see you, Randy, and I'm honored to be the first podcast interview.
Well, I thought of you when we were setting this whole thing up because you've seen it all. You've been there on the front lines with both private investing, and you've financed deals and invested as an equity investor, and you've taught it too. So you've had to sit in front of students and answer questions about the history of the business, and I thought you'd be the perfect guest. Plus, you're a great friend of ours in the firm. So thank you for all that. I thought it would be helpful to start with, goodness gracious, where we stand today, and as we're taping this in March 2023. And if I had told you, Steve, back in January that Silicon Valley Bank would file for bankruptcy and Credit Suisse would collapse into the arms of UBS by the end of the first quarter, would you have believed it?
I think it's a fascinating question because I think there are multiple layers. If you had told me in January of 2020 that there would be a global pandemic which would disrupt supply chains and change the culture of how we work and communicate forever, would I have believed that? If you told me in January of 2022 that Russia was on the verge of launching a full-scale invasion of Ukraine, and then with other implications would, disrupt the energy business and have meaningful impacts on how NATO operates, would I have believed that? And so now you ask me the question, in January 2023, would I believe the failures of those two institutions? The answer for me is, would I have predicted any one of those things? Absolutely not. But would I believe them? Yes. And I think the lesson that we should take away from this is that, and this is how I really think about when I invest and when I think about asset allocation, there are always market disrupting risks lurking in the markets. And you just cannot plow ahead assuming that these risks won't show up. So can you predict exactly what they'll be? No. But should you be aware that something can happen that will disrupt these markets? Yes.
And given what you just outlined in terms of something can always come out at you, the unknown unknowns, as an investor for many, many years, when you look at the kinds of things that investors are dealing with, these crosswinds, whether it's global issues and we're not even talking about North Korea launching missiles every 5 minutes. How should an investor, and how do sophisticated investors think about dealing with risk? Because risk is what you think about, right? It's like, what could upset my investment thesis? How should investors approach the world that we're living in right now?
Well, it's always a challenge to predict what the next investment class and where your money should be right at the moment. So you have to have a longer term outlook. And, we know from years of experience, research experience, or watching, for example, David Swensen manage the Yale Endowment very, very effectively over decades. You want to be well allocated, and you want to generally be leaning to having an equity bent, because in the long run, particularly in the United States, The economy and the stock market is very resilient.
Mm-hmm. It has been. And when you talk about looking at, for example, a diversified portfolio approach, right? Because that's helpful. Do you think that the classic 60-40 equities fixed income is still operative, just given the fact that you've been involved in the alternatives end of the market from a private equity and credit perspective for a long time? Has the 60-40 model been changed as a result of how alternatives and particularly private capital has behaved in ways that are probably pretty helpful for investors right now?
I think long term for most institutions and for most individuals, the 60-40 mix is not an ideal mix. And, with that answer, let's sort of look at the particulars of the Silicon Valley Bank demise, for example. They manage their balance sheet in a way that you and I would not. They loaded up on long-term fixed income assets matched against short-term liabilities. That's a bad mix. And they didn't manage the rise in rates very effectively either. So there's a combination of kind of bad decisions and then bad reaction to those decisions that in part created their problem. So they were not a 60-40 mix, but a 0-100 mix or something like that. The second particular problem with Silicon Valley Bank is the reaction of the ecosystem that was the primary user of that bank that kind of created or instigated that demise, and that created the general or the classic run on a bank. Silicon Valley is always kind of looking for the new thing, and so they do tend to move in a herd mentality. And so once that herd moved, it created this failure because of the systemic problems at Silicon Valley Bank. And ironically, that fleeing kind of torpedoed the one or a very important participant in that ecosystem, a very important and supportive building block in that ecosystem. So I guess that was a long-winded way of saying, no, I don't love the 60-40 mix, because the 40 puts you in a lot of long-term fixed income securities, and I don't think long-term that's very effective. One, it's not going to grow. That those assets, those fixed income assets, won't grow if the economy grows. And two, you are locking into something where you're going to run risk of suffering damage from inflation. And obviously we have seen that in the last several years.
So just to take that thought a little further about what caused the failures of these three banks in the last several weeks, we remember 08, 09, I'm sure you probably had flashbacks this month thinking about what happened then and bank failures and so forth. And the irony, of course, back then was it had nothing to do with leveraged lending, or even though the banks had essentially been told, don't hold risky loans, it was subprime mortgages that got banks into trouble back then. And it wasn't leveraged loans that got them into trouble this time either. It was, as you said, the mismatch, and also, frankly, some of the tech lending that was going on with SVB, and to some extent what was the result of the Fed having raised rates so quickly that they were stuck with a portfolio of very low interest rate bearing mortgages and so forth. And that certainly didn't help. But if you just think about, and you've been on the front line of migration of lending from the banks to the non-banks, maybe just to move the conversation to private credit, when you look at the current debt landscape, what do you see now to compare and contrast to where we were 3 years ago, 5 years ago, 10 years ago, in the way that finance, sponsor finance particularly, has moved from the public credit world, if you will, to private credit?
Right. Well, again, you've asked a very multi-layered question. If we go back to 2008, the one thing that I tried to do was to buy senior debt. And that was difficult to do as a retail investor. There was really no opportunity for that. And the reason I wanted to do that is because I saw that, as you point out, the failures was not related to, or were not related to, economic failures of businesses necessarily, but those private loans dropped in value to about 60 cents on the dollar, which meant the yields to maturity were really high. And at the same time, we saw the federal government put out a lot of money to try to rescue the economy and solve the problem. Now, I'm not making a commentary on whether or not that was the right or the wrong decision. I'm just saying this is what happened. And so now what do we do now that that's happened? And I think along the way with all this government spending, I anticipated at some point that we would see a rise in rates and inflation. Now, I was wrong for many years, being anticipating that event. But what I tried to do was say to myself, okay, well, if there's going to be inflation and a rise in rates, and right now your cash alternative or your fixed income alternatives are providing almost zero return, where can you go to get a return if you're also concerned about the volatility in the stock market and you want to have sort of an anchor to windward? And the answer I felt was private credit. And I still feel that today because the private credit is all senior debt and it's floating rate. Historically, that asset class, number one, is a very good hedge against inflation and rising rates. And number two, has had very, very small defaults because it's senior debt. And if you're playing in the middle market, you have covenants and you're going to hold the asset to maturity. So you're not really worried about trading volume. So all of those things I felt were a good place to park money as a very good alternative to cash. I'm not saying it was necessarily the best alternative in terms of stocks versus fixed income. But if you had cash and you were concerned about market volatility in the equity markets, I don't think there's a better place to be as an investor.
So let me dig a little deeper and ask you, in the current environment, one of the things that investors say, particularly those who are educated in private credit, and they like, in fact, they may be investing right now, the thing they ask is, well, sure, it's great now, particularly with yields up. I could get 10, 11, 12% on secured, unlevered senior credit. But gee, I could also get kind of 6% on investment grade bonds. That seems like a pretty good risk premium for that kind of credit. Why shouldn't I be putting my money there? How would you answer them?
Well, again, I go back to the 60-40 question. A long-term bond, you are just locked in. And yeah, rates might move in your favor and the value of the bond might go up, and then you might be able to trade out of it. But it's really difficult. My dad used to ask me questions when we made a bad investment. He would say, well, why did you buy that business? I'd say, well, Dad,
Yeah.
here's the problem. It's damn hard to predict the future. You can do a lot of due diligence and try to understand where you think things are going, but predicting the future is impossible, as we all know. So I think you want to be in an asset class. If you're not investing in an equity linked security, then I think you want to be in an asset class where you're protected if rates rise, and where the default rate is really low, or the default risk is really low. And if you're buying corporate bonds, you are locking into a fixed rate contract with a business. That fixed rate contract might be right for today's environment, but in 5 or 10 years, it might not be right. And the company may not be right either. So, you're getting that yield, but you're locking into a long-term contract with a business that 10 years from now, you will have a very hard time predicting whether or not that company is a great company, and whether or not rates 10 years from now will be what you think they are going to be today.
So you mentioned default rates are pretty low, and one of the knocks against private credit is these companies are private. They're middle market companies. They don't have any ratings. Their numbers are not obviously out there. There's no research on these businesses. How, as a private credit investor, do you get comfortable with the portfolios? Since you can't look at the rating and say, oh, it's a double B, or you can't look at the comparable where the bond is trading on these businesses or what the market value is. Those market values tend to be privately, usually with third party help and assistance on coming up with values. But how do you get comfortable with that? The lack of information that's out there publicly. I mean, you have to dig deeply into these businesses, or the manager has to. How do you answer people who say it's really hard to judge what that risk is?
Well, when I assess private credit, I'm relying on the private credit manager, who is going to have a process in place. That's a due diligence process before they make a loan. And the managers that I work with are all making loans to companies that are being purchased by private equity firms, who are also in turn doing their due diligence. And those firms obviously are not in it to lose money and take risk, and they are going to support those portfolio companies. And the benefit of the private credit lender is that it's a secured loan, meaning it's senior on the balance sheet, comes ahead of any other claim. And the idea that these companies are in a large group going to lose half of their value is not very plausible. And so I'm comfortable with where private credit sits on the balance sheet. I'm comfortable with the fact that it's secured. And I'm comfortable with the fact that these portfolios are highly diversified. And I'm comfortable with the fact that the lenders are opting into certain industries and opting out of other more volatile, riskier industries. So that's how I get comfortable. And by the way, in these private credit portfolios that you're talking about, as a result of the fact that they're private, as an investor, I'm getting a premium, and I'm getting a pretty good premium, given that the risk I perceive as quite low.
Steve, you mentioned industries. Your focus at J.W. Childs was consumer products, healthcare, retail.
Yeah, things we could understand.
Yeah, there you go. So when you look at the landscape today, 2023, with all the crosswinds we just talked about, what do you like? What industries do you think are resistant to interest rate movements, supply chain issues, and the kinds of things we were talking about at the beginning of the conversation?
I don't know if I could narrow it down to an industry. What I look for are things that solve real problems, and companies that have some kind of differentiator to solve that problem. So I don't really think about industries in the way that, what industry do I want to go after now? I'd rather be diversified. Now, there's certain industries that I avoid personally just because I don't understand them. Like, I'm not likely to invest in a biotech company, although I happen to be looking at one right now. But and I'm not likely to invest in a company that's doing, some kind of deep technology that I won't understand. So I would say generally for investors, try to invest in things. It's the old Peter Lynch rule, really, which is invest in what you know.
So as we wrap up the conversation, and this has been fascinating, and you mentioned, what happened in January 20 or early 2020 with the pandemic, and then 22 and this year. Let's say you're kind enough to join us again a year from now, and hopefully we'll have you on before then. But let's say we're looking back together at 2023 a year from now. What do you think we'll be talking about? What was the year of 2023 like?
Long pause. Again, it's hard to predict the future, but the one thing I know we'll be talking about is something that we didn't think we'd be talking about. Generally, the outlook is pretty good right now. And so I think we'll be talking about investors having a relatively uneventful year, but I would invest assuming that that's not going to happen.
So be hoping for the best, but expecting less than the best.
Well, you have to, at some point over the next, if you're a long-term investor and you want to look out 3 to 5 years, you have to assume that in that 3 to 5 years, there will be some shock to the system. And the question is, if there's that shock, are you positioned to withstand it? If you have a 20-year view and you're 100% in equities, you're probably okay. But if you do want to sort of have an anchor to windward, again, I think you want to be generally equity biased. But if you do have dry powder, I think private credit is a great place to be. And the other important thing about private credit, which I don't know if I mentioned, is that you do have a much shorter maturity. The average maturity is something like 3 years or 4 years in these private credit portfolios. So if you're in trouble, you're going to be out of it pretty quickly.
Steve Siegel, thank you so much. I really appreciate your time on Private Capital Call, your experience, which is obviously so interesting, and your background is great. Love to have you on again to talk about the year as it progresses and tap your brain on some topics I know our listeners are interested in. So really appreciate your time.
Thanks, Randy. It's always a pleasure to catch up with you.
We've been speaking with Steve Siegel, formerly executive in residence and lecturer at Boston University's Questrom School of Business and a special limited partner of J.W. Childs Associates. For more conversations with institutional investors and asset managers of private capital around the world, please join us for Private Capital Call. This is your host, Randy Schwimmer.